1929, 2008, 2020. Every crash on Wall Street wiped out trillions of dollars, but also left behind priceless lessons that reshaped how the financial world operates. And if you think history doesn't repeat itself, just wait until you see how often it rhymes. Picture this. Over the past century, Wall Street has lost more than $10 trillion across major crashes. But here's what's fascinating. Each disaster became a masterclass that transformed how banks operate, how investors think, and how governments respond to the next crisis. What has Wall Street truly learned from a century of financial disasters? And are we any better prepared for the next big one? Stick around, because the answers might surprise you. Let's start with the granddaddy of all crashes, 1929. Imagine standing on the trading floor as the ticker tapes roll, and you realize you're witnessing the end of an era. By August 1929, brokers had lent over $8.5 billion for margin buying. That's more money than the entire currency in circulation at the time. People were buying stocks with just 10% down, borrowing the rest. It was a house of cards built on pure speculation. Then came Black Tuesday, October 29th, 1929. The Dow Jones plummeted 12% in a single day. Over 16 million shares traded hands. Fortunes vanished in hours. But here's the thing. The crash itself wasn't the real lesson. It was what happened next. The banking system collapsed. No safety net, no deposit insurance, no central bank willing to step in. What followed was 25 years before the market recovered to pre-crash levels. Wall Street's first brutal lesson: unchecked speculation without regulatory guardrails leads to systemic collapse. The response was revolutionary. Congress created the SEC to police fraud. The Glass-Steagall Act separated commercial banks from investment banks. They established the FDIC to ensure deposits. These weren't just band-aids, they were the foundation of modern financial regulation. And here's what's remarkable. These Depression-era reforms worked so well. We didn't see another banking crisis for nearly 80 years. Fast forward to October 19th, 1987.
Just came from inside and it looks like a madhouse.
It's so crazy, nobody even expected it to be down this much.
Hour after hour today, wave after wave of selling hit the stock market. A selling panic, the professionals call it.
Black Monday. The Dow Jones crashed 22.6% in a single day, the largest one-day percentage drop in history. But this wasn't your grandfather's crash. This was the first global crash of the computer age. Program trading, portfolio insurance, automated systems that were supposed to protect investors, instead created a death spiral. Computer algorithms triggered massive sell orders, which triggered more sell orders, which triggered, you get the picture. Picture the chaos. Trading floors overwhelmed, phone lines jammed, and computer systems that were supposed to make markets more efficient, actually making them more fragile. The lesson Wall Street learned: technology can amplify panic at lightning speed. But here's where it gets interesting. Unlike 1929, this crash didn't lead to a depression. Why? Because the Federal Reserve had learned from history. Within hours, Fed Chairman Alan Greenspan issued a statement. The Federal Reserve affirms today its readiness to serve as a source of liquidity to support the economic and financial system. One statement: immediate action, market confidence, restored. This established what we now call the Fed put, the idea that the central bank will step in during crises. It's a backstop that shapes how every investor thinks about risk, even today. Jump to March 2000. The Nasdaq had climbed 600% in 5 years. Companies with no profits were worth billions. Pets.com spending millions on Super Bowl ads, while burning through cash. It was the era of irrational exuberance, a phrase coined by Fed Chairman Alan Greenspan himself. Investors threw fundamental analysis out the window. Revenue? Who needs revenue? When you have eyeballs and clicks. Then, reality hit. The NASDAQ crashed 75% from its peak. $5 trillion in market value, gone. Companies like Pets.com, Webvan, and hundreds of others simply vanished. Wall Street's lesson: fundamentals always win in the end. The crash forced a complete rethink of how we value companies. Venture capitalists became more cautious. Investment horizons stretched from 18 months to 5 to 7 years. Due diligence made a comeback. But the real change came in corporate governance. The Enron and WorldCom scandals that followed led to the Sarbanes-Oxley Act, stricter rules for financial reporting, more independent boards, and CEO accountability. The message was clear: hype might drive prices up, but only real business models keep them there. Now we get to the big one. 2008. The housing bubble had turned mortgages into weapons of mass financial destruction. Banks were packaging subprime loans into complex securities and selling them worldwide. Lehman Brothers, 158 years old, survived the Civil War, 2 world wars, the Great Depression, collapsed in a single weekend. The financial system froze. Credit markets shut down. The global economy teetered on the edge. Picture this moment: every major bank CEO getting called to Washington, hat in hand, being told they would accept government capital, whether they wanted it or not. 8.7 million Americans lost their jobs. $17 trillion in household wealth evaporated. It was the closest we'd come to another Great Depression since, well, the Great Depression. But Wall Street learned its most important lesson yet. The system had become too interconnected to fail, without taking everyone down. The response was massive. The Dodd-Frank Act created new rules for too-big-to-fail banks. Basel III required much higher capital reserves. Annual stress tests, mandatory. The Volcker Rule banned risky proprietary trading. Most importantly, central banks learned to act fast and big. When COVID hit in 2020, the Fed didn't hesitate. They cut rates to 0 and unleashed unlimited quantitative easing within weeks, not months, and it worked. The 2020 crash, the fastest bear market in history, also had the fastest recovery. The S&P 500 recovered all its losses in just 181 days. March 2020 proved that Wall Street had learned from its past. When panic hit, and everyone rushed for cash, the banking system held firm. Why? Because banks entered the crisis with the strongest capital positions in decades. Those post-2008 reforms actually worked. But the real test was operational. Overnight, entire trading floors went remote. Critical market functions that had never been done from home suddenly had to work from kitchen tables and home offices. The system adapted. Markets stayed open. Credit kept flowing. Wall Street's COVID lesson: resilience isn't just about capital. It's about adaptability. So what has Wall Street truly learned from a century of crashes? First, that speculation and leverage are like fire, useful tools that can burn down the house if not carefully controlled. Second, that technology amplifies everything, both the booms and the busts. Third, that fundamentals always matter, even when everyone's ignoring them. Fourth, that in a connected world, no institution is too big to fail without threatening the whole system. And finally, that the speed of response matters more than perfect solutions. But here's the thing about Wall Street. It has a short memory. Each generation thinks, this time is different. The players change. The technology evolves. But human nature stays the same. The next crash isn't a matter of if, it's a matter of when. But if history has taught us anything, it's this: the markets always fall, and those who learn from the past are the ones who rise. Because in the end, Wall Street's greatest lesson might be the simplest one. The only constant is change, and the only protection is preparation. What do you think? Are we really better prepared for the next crisis? Or are we just fighting the last war? Let me know in the comments below. Thanks for watching. If you found this video useful, don't forget to like, share, and subscribe to the Capital Compass, so you won't miss any future deep dives into the forces shaping our world. See you in the next video.